One of the biggest fears that I have as an investor is, what if I invest at the wrong time? What if I invest just before a crash and I lose all my money? Especially when we're hearing the eye-watering returns that some individual stocks are making at the moment. Well, taking a listen to this.
Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. It never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business.
That's the great Warren Buffett himself, one of the best investors of all time, clearly admitting he does not know which way the stock market is going to go. Welcome to the live stream. I'm Tomo, and I take difficult financial concepts and explain them in an easy to understand format. And tonight, I'm going to take you on a little bit of a journey, and I'm going to explain to you and show you that why investing at the perfect time is perhaps the wrong question. Quick disclaimer, I'm not a licensed financial advisor. This video is for educational purposes only. Any information in this video is just general educational information and is not a buy recommendation on any stock that we talk about. There's a lot of money to be made in individual stocks. We're going to take a look at another video. It's one of my videos. Companies like Nvidia, who make computer chips, and had a return of 170% in 2024 alone, and over the last 5-year period have had a return of 1,500%. Or Palantir, with some of its biggest customers are large government agencies that use its data and analytics models to make decisions. They had a similar return to Nvidia. And from an Australian perspective, I've mentioned Zipco already, but a medical imaging company called Pro Medicus, which over the last 5 years has had a 1,200% return. And keeping in that theme, a company called Telex Pharmaceuticals, which specializes in radiopharmaceuticals, has also had a return of 1,000% over the last 5 years. So as can be seen there's some eye-watering returns that can be made in individual stocks. So I guess the next logical conclusion, the next logical thought that someone might have is, why don't I play in this space? Why don't I invest in individual stocks and try and buy at the right time to really hit a grand slam, really hit it out of the park? Well, what if I told you that 80%, more than 80% of professional investors, people that spend day in and day out looking at companies, reading financial statements, looking at businesses, 80% of professional investors were unable to beat the total returns of the stock market as a whole. That means that the stocks that they've picked, the performance of their portfolio was unable to beat the total S&P 500 return that a passive investor could have bought. You could have bought an ETF that tracks the index as a whole. Those professional investors were unable to beat the returns of the stock market as a whole. You'd probably think I was crazy. You'd probably think I was nuts, but unfortunately, it's true. There's tons of articles here. There's one here on the Motley Fool, which I've just pulled up, which says, and as a result, it found just over 8% of active large cap US equity stock funds, professional investors, have outperformed the S&P 500 over the last 20 years. That's actually worse. That statistic's actually worse than the one that I gave you. Professional investors picking individual stocks, trying to pick the right time to buy those stocks, were unable to beat the total returns of the S&P 500 as a whole. What does that leave you to do? How, as a beginner investor, how, as an individual investor, are you supposed to be able to pick the right time to buy stocks? Well, I said we're going to go on a bit of a journey. To ease your mind a little bit, let's take a look at what would have happened had you have bought stocks at some of the worst times, some of the absolute worst times in history, and let's see what would have happened. So during one of the biggest, most memorable stock market declines was the global financial crisis, the housing crisis in the United States, global financial crisis in 2008. So had you have invested $10,000 on the Friday before the global financial crisis crash in 2008. This is a stock chart of the S&P 500. So had you have bought stocks on the Friday before the global financial crashes in 2008, then 6 months later, your investment would have halved in value. That's pretty brutal. You would have lost half your investment had you panic sold in a 6-month period of time. But here's the really interesting part. Had you not panic sold and had you held on to that investment, Then by 2020, so here's 2008 down the bottom here. Then by 2020, your investment would have doubled in value. And if you had have reinvested any dividends, then your investment would have almost tripled in value. Now again, past performance is not an indicator of future performance. This is not any stock recommendations. But had you invested at one of the worst times in history and you adopted a short-term mindset, had you panic sold your portfolio, you would have realized a 60% loss. However, had you hung on, had you hang in there and had a long-term time horizon, then in just the space of 12 years, 2008 to 2020, you would have doubled your money. And had you reinvested any dividends, you would have almost tripled your money. So doubling your money is far, far better than not doubling money if you have a long-term time horizon. Let's take a look at another example. This is the dot-com bubble in 2020. Again, I was a bit lazy with the math on this one, but you can see this massive, massive decline. 2020, the dot-com, all these internet companies that didn't really have any earnings, didn't really have any profits. I'll leave you a link to a recent video I've done in the description around that one. There was a massive, massive stock market hype. Prices increased dramatically in the stock market, then it crashed. So to make your money back would have taken you 8 years just to make your money back. That's not as good a story as the previous example I gave you. But and what I'm going to talk to you about is this down part of the trend. That's what we're going to talk about a bit later in the video. But then again, had you hang on, if you take that longer term view, it's really just a speed bump. But it's these downward trends here that I want to talk to you. So what can we do as individual investors, as beginner investors, to try and overcome these shortfalls, overcome these difficulties, or overcome these impossibilities in picking the right time to invest in the stock market? Well, one strategy that you possibly can adopt is, instead of buying individual stocks, is looking at things that are called ETFs, things that track the market as a whole. That's possibly one strategy that you might adopt. I've done some videos on that, I'll leave in the description. And instead of trying to pick the right time to invest, one strategy that you could possibly adopt is what's called dollar cost averaging. And what dollar cost averaging is forgetting trying to time the market, forgetting trying to pick the specific or the very right time to buy stocks. What dollar cost averaging is choosing a sum of money that you can afford to invest on a regular interval. And I would normally recommend aligning that with your pay cycle. That's generally what is a good strategy to adopt. Should be a sum of money that's not going to send you broke. Should be a sum of money that's not going to leave you eating baked beans for the rest of the week. A sum of money that you can afford to invest at regular intervals. It doesn't matter if the stock market's high. It doesn't matter if the stock market's low. You invest that sum of money at regular intervals. And what happens is, when the stock market is high, you naturally buy fewer shares because you've got that fixed sum of money. And so because the stock market is high, you buy fewer and fewer shares just naturally. When the stock market drops, you're still investing that sum of money. You can buy more and more and more shares. And over a long-term time horizon, you get about an average price. Takes a little bit of the volatility out of the stock market, takes a little bit of volatility, takes a bit of that guesswork out of the stock market. Now I want to show you another example, and this is just purely for the sake of an example. It's from Reddit, so don't take it as absolute gospel, but this does give a good illustration of this principle in practice. So dollar cost averaging, you could have a choice of investing a lump sum up front, or instead of investing a lump sum up front, so here in this example, you have the choice of investing $8,000 up front in a lump sum, or splitting that into $1,000 and investing on a periodic basis. And this gives a really good example of how the dollar cost averaging really works in practice. So where the stock prices goes up and the stock market goes up, you naturally buy fewer shares. And then when the stock market goes down to $9, you naturally buy more shares. And this example is working in the dollar cost averaging favor. But over the course of it, you then receive about an average price for the stock. So this is just a really good illustration of how dollar cost averaging works. And if you're a beginner investor, for that matter, even if you're a professional investor, if you're a beginner investor, why even bother trying to time the market. The age-old saying is that time in the market beats timing the market. So if we look back at those grid lines, if we look back at those stock charts, even on, this is just buying at the worst time during the global financial crisis, your $10,000 would have became $20,000 after 12 years. Had you kept on buying on the way down under a dollar cost averaging approach, then your returns would have been much, much higher. Much, much higher. So the stock market is a little bit expensive at the moment. I'll leave a link in the description of a recent video I've done that talks about that. However, as individual investors, one strategy that you can possibly adopt is this dollar cost averaging. It takes the emotion out of investing, takes the psychological elements out of investing, and over a long-term time horizon, history shows that you can do well out of it. Hope you enjoyed the video. If you adopt a dollar cost averaging approach, leave me a comment below. I'd love to hear from you. Thanks for stopping in. See you in the next video.